we had this, right? So in this, this was only for explanation. Generally, subsidiary company, there is no journal entry. It's only for just explaining you guys. So there will be only the parent company transaction. Now, uh, let's say, so this journal entry over here, let me just see. Let me just quickly revise the question. So question was that for the book value of 600 in subsidiary company. So here, if you see, this is the balance sheet of the subsidiary company, and book value is nothing but the equity value. So here equity value is 600, which includes $100 of common stock, $100 of APIC, and $400 of retained earnings, right? So total of $600. So this was your book value, whose fair market value was 700, because the asset, which is equipment of $500, the fair market value of this equipment was $600 in actual market, but in the books it was $500. So because of that, the fair market value means if you want to sell whole of your shares in the market, you will get 700, right? So that was there, the fair market value. However, this parent company, P company, bought this S company's shares worth 700 in the market and worth 600 in the books for $900. Okay. So by this, what we understood is $100 is because of the fair market value increase, excess fair market value, and $200 was the goodwill of the S company, for which P company has paid extra amount, right? So the journal entry that would have been would in P company, obviously P company have invested $900. So that should be the journal entry, which is investment account 900 to cash account 900, right? So this was the only journal entry made at the time of acquisition. Now, if there is no other transaction in S corporation and P company, and we have these as the final balance sheets at the end of the year. So, if you see, we have 900 in the investment. So, ideally, let me just make this way that before acquisition, the the balance sheet of P company would have been $1,000, $8,000, zero, $9,000, and these remain same, right? And after acquisition, 900 has been removed from cash and gone to investment in S, right? So this is at the end of, so maybe December 31, year one. December 31, year one. So every year you will be preparing this. So every year you will be preparing this, like the P company's balance sheet separate and S company's balance sheet P&L separate. However, this consolidated worksheet needs to be prepared uh, at the end of the year, right? So this consolidated worksheet is shown just like this in addition to the balance sheet of P company, right? Now here, what we did was, so this is December 31, this is December 31, this is December 31, year one. So everything is happening in the on one day only, right? So when you are consolidating, you have to remove the intercompany transactions. So in order to remove the intercompany transactions, first of all, this investment needs to be removed, which is 900. So that's why we credit that 900, right? Along with this, all of these shares, $600, that is this book value of subsidiary, has been purchased by subsidiary, the parent company. So these needs to be removed from here, right? So that's why we debited the common stock and APIC and retained earnings. Then, since you have paid 300 extra, so that 100 needs to be added in equipment because that is something which is increasing the value of the equipment after the sale, right? So, and in S company, it is showing at book value. That is the 500. So you have to increase it to make it 600, 700. Total 700 you have to make, right? So that's why $100 is added to the equipment, and remaining 200 was goodwill, which is not shown in neither P company's balance sheet nor in S company's parent balance sheet, but directly in the consolidated balance sheet. Okay. So now moving forward, this was something that we did last time. Right. Now, moving forward, what is happening? What if this has happened in the first year? Now, we have to prepare the consolidated return for the second year. So, the acquisition has happened on December 31, year one. Now, let's say, so this case we have done, and now we are starting with this case. Like, bought on the first day of the year or in the previous year, you have bought the 100% shares. So, let's say during the period after this acquisition, there are few transactions happened, right? Like goodwill got impaired by $5. Okay, so this is when a transaction happened in escrow, in subsidiary books, okay, or consolidated books, subsidiary or consolidated books, because goodwill is not there in subsidiary books as well. So at the end, when you are consolidating the return, the financials, you you checked for the goodwill impairment and found that it is now worth $195 only. So the book value here, instead of 900, now the value of the company is 895 as per se, right? So 900 was 1 year back. After 1 year, it is now $895 only, right? Apart from this, there was income of, so goodwill, then income, parent earned $3,000 and S corporation earned $150. Okay. And yeah, I think, and equipment useful life. The useful life of equipment was given 5 years. Okay. So this useful life of equipment will definitely depreciate the values of this, right? So we need to check that also, like how it will impact the uh, company's consolidated return.